Hi everyone. So welcome to the stream today. Very much excited for having you once again on the stream. Today we're looking at planning an audit of financial statements, that is ISA 300, looking at something in relation to audit and assurance or advanced audit and assurance for your examination in relation to that. So if you joined the stream, welcome. If you have any questions, you put it in the chat box and also give us a thumbs up on the video. That way we get more engagement and we will be able to reach many people, because YouTube will be able to push the video so we can reach a lot of students, a lot of people just like you in relation to that. Now, the reason why today we wanted to, or we are discussing something in audit and assurance, is that we've received a couple of requests from students saying that, oh, we've not really covered a couple of things on audits. And so I decided, all right, as part of our executive revision masterclass online that we are having, we need to discuss a couple of things, because this particular topic in audit is very critical, because it covers a lot of things when it comes to auditing. To be able to perform a quality audit, understand the various audit procedures to undertake, how you gather audit evidence, you find out the issue in relation to substantive testing and all that. You will be able to do that well if you are able to plan the audit in relation to that. So if you join the stream, welcome to the stream, and then comment in the chat box with all of your All right, so I see a couple of you joining in relation to that. Patient, patience, pain still. Greetings, sir. Greetings, patience. Jonas, I see you. You are welcome. Patience said, please, do you have specific timing for the live streaming, please? Yes, it's 4:30 p.m. every day, 4:30 p.m. or 16:30 GMT. So every single day in relation to that. So patients, if you ask about the time, that is it about that. Then patient said, no sounds, please. I guess you can hear me now. Let me know in the chat box if you can hear me, and give us a thumbs up on the video if you joined the stream. Okay, so let's see what we got. Any questions for me? Okay, so patient said the sound is okay now. That's great. So let me share my whiteboard with you, then we can get into it. So if you have any questions, yes, patients, 4:30 p.m. to usually 6:30, 6:45, thereabouts. Sometimes if the questions comes a lot and I want to address everything well, we actually take it to 7 p.m. in relation to that. So from 4:30 to around 7 p.m. So audit planning. Thank you very much for joining the lectures in relation to that. Okay. When will the lecture end? Okay, patients, I guess I've answered you now. 4:30 to 6:30, but sometimes it could extend to 7 p.m. based on questions that I have in the chat box and me wanting to address all of your questions in relation to that. So usually it's going to be like 2.5 hours journey or so in relation to that. Any questions for me real quick before I go into the day's business on audit planning? If you have any questions, please put it in the chat box and I'll answer them for you in relation to that. So patient said, God bless you for the feedback and answer. Noted with thanks. God bless you too, patience. Sarah Wadie, please, is this class for both audit and assurance and advanced audit and assurance? Yes, Sarah. Audit planning actually cuts across in relation to that. So it is for both audit and assurance level 2 and advanced audit and assurance level 3. Cletus, good evening, sir. Just to greet and leave since I'm not doing audit. Yes, Cletus, today you are not going to be part, so that's okay. So you make sure you enjoy the rest of your day. Definitely tomorrow you will be part of the stream. Patients said 2.5 hours every day at the same time. Yes, patients, all other things being equal, 2.5 hours every day in relation to that. Kwabena Boatin, good evening, sir. Good evening, Kwabena. Is this the Kwabena Boatin I know? Branana, is it you? Let me know in the chat box. Any questions for me, please put it in the chat box. Maybe you have any question that you want me to talk about before we go to the day's business or the day's lecture. So if you have any questions, you can put it in the chat box before we go to the day's lecture. Sarah Wade, well noted with thanks. You're welcome, Sarah. Okay, so welcome to the stream. And like I mentioned, this is one of the critical areas when it comes to dealing with advanced audit and assurance and audit and assurance audit planning. So it's going to be quite an extensive session that we're going to be having today. I'm going to be talking about a lot of things here because when you're dealing with audit planning, risk assessment is going to come in. You must understand various issues about the audit procedures that we undertake, the AEIOU, the issue in relation to analytical procedures, inquiry, is inspection of documents, and then observation, and all of those, we're going to be looking at them because they are part at the planning stage of the audit. A couple of these are carried out in relation to that. Patience said, all right, I am happy to be part of your class. Okay, Patience. Kwabena said, yes, so this is Nana Kwabena. All right, Nana, so you are welcome. Any questions, please put them in the chat box and I'll be addressing them for you in relation to that. Maybe you have a question that does not relate to audit or advanced audit and assurance. You can still put it in the chat box. I will answer it for you, and then we can start with the discussion today in relation to that. So this is in the series of the online executive revision masterclass that I'm holding for you guys on the channel here, to assist you to study well and also share with you the key things you need to understand in order to increase your chances of passing the examination. Now, before I go into the audit planning, let me say this, that when it comes to the audit and assurance, there are a couple of issues that you must understand and a couple of key areas that you need to focus on in order to increase your chances of passing the examination. One of the critical issues that are fundamental that the examiner will always examine you on, especially in level 3. It is examinable highly in level 2, but this is compulsory in level 3, literally, and that is going to be ethics. Now, you got to be careful when it comes to dealing with questions about ethics. Now here, you're not just going to be writing down things like integrity, professional competence and due care, professional behavior, confidentiality. No, the examiner is going to pull a scenario up and you have to identify what is the ethical issues rising and what is the appropriate course of action that has to be undertaken. Or for instance, there is a scenario given to you and you realize that the auditor gathered a couple of evidence relating to a certain item that they are looking at in relation to that. But the question you need to ask yourself is, okay, the evidence that they have gathered, is it enough? Can they conclude on the evidence that has been gathered in relation to that? So we need to look out for the issue in relation to that. Then as we were examining the evidence, we realized that, oh, there was an item that was an error in the previous year financial statement, and in the current year financial statement, it hasn't been adjusted. And when you speak to the COO or the Chief Finance Director, the Chief Finance Director said, oh, let it slide. In such situation, what is the ethical issue there, and what is the course of action that we have to undertake as auditors, as professionals? Now, yesterday, I shared a couple of things about ethics with you as we were talking about the verbs used in the exam hall. And I told you that when it comes to dealing with the appropriate action that has to be taken when it comes to ethics, 3 general things. Number 1, you confront the issue so the right thing will be done. Number 2, you seek advice either from your legal team or from the regulatory body or something like that. And then number 3, you resign in relation to that. So usually when it comes to dealing with the appropriate course of action about ethics, these 3 things cut across. But as you're going into the exam hall, this is a critical area. You must make sure you understand ethics. The second thing is what I'm going to be talking to you about today, and that is audit planning. Very, very critical area, because in this bracket, we're going to be dealing with a couple of issues. Because you see, generally, this is how the audit process is. There is an appointment, okay? After the appointment, we plan the audit. When we plan the audit, as we are planning the audit, we need to understand the client. If we are able to understand the client very well, it will assist us to assess the risks of material misstatement. Why do we need that? Because once we are able to assess the risks of material misstatement, we will now be able to respond to the risk and decide the various audit procedure that we have to undertake in order to design our audit in relation to that. So this is a fundamental area of the syllabus. So at the appointment, what do you do? What factors do you take into consideration before you accept an audit? All right, if you look at the issue about ISA 220, quality audits, in relation to that, let me look at the right name there. Quality control for an audit of financial statement, that is ISA 220. You need to look at the issue about independence. You need to look at the outgoing auditor. If this is not the first time the firm is undertaking the audit, you need to consider the issue about whether you are qualified, you have the expertise, you have the resources. All of those things happen at the appointment stage of the audit. Once you are done with that kind of arrangement, that kind of understanding, then it comes to the huge aspect here, which is the ISA 300, planning the audit of financial statement or planning an audit of financial statement. And that is the second level. Now, as you are planning the audit plan is usually divided into two, which we'll be looking at in a moment. We're going to look at the audit strategy, and we're going to be looking at the audit plan. Now, as you are planning your audit as to how you're going to be undertaking the audit, you need to understand the client entity. What kind of internal controls do they have in place? Who are the managers? What is their competitive level or competition level within the industry they are in? That is very important, because once you understand the client entity like that, then you can assess the risks of material misstatement. In a simple language, the risks of material misstatement simply means what could go wrong. All right? The risk of material misstatement simply means what could go wrong. So based on our understanding of the client entity, then we can what? Assess the risks of material misstatement. And this is where we talk about the audit risk, and which is involving the issue about inherent risks, control risks, and then the detection risks in relation to that. The inherent risks and then the control risks together forms what is called the risks of material misstatement. And then the detection risks is from the auditor in relation to that. It is the objective of the auditor to reduce the audit risks by reducing the detection risk to an acceptably low level, because the auditor has no control about the inherent risks. The auditor has no control about the control risk. But what the auditor has control over is to plan his audit in such a way that he will be able to identify any fraud, errors, and material misstatement in the financial statement, should they exist, in relation to that. So once we understand the client entity, we assess the risks of material misstatement, that is preliminary materiality. And then when we start the work, we now set the performance materiality. Then the auditor will respond to the risk. The auditors respond to the risks. It's based on the effectiveness of the controls that are in place by the organization. So if the auditor expects the control systems to be effective, then he will test the controls to see if we are going to get a satisfactory result or unsatisfactory result. But if the auditor expects, based on the understanding, based on the information we have about the client entity, that if internal controls are ineffective, that means that the auditor is going to respond to any significant deficiencies on the internal controls and reports that as well to management and those charged with governance in relation to that. Then, under that circumstance, the auditor is going to undertake a full substantive procedures. But where the auditor expects the internal controls to be strong, to be effective, and he tests the controls and he gets a satisfactory result, then the auditor is going to reduce the substantive procedures, so that he will just look at some tests and identify the risk areas of the audit and then examine those things in relation to that. So basically, this area, audit planning, it's critical, and that is something that we need to understand, and we'll be going into that in relation to that today. I see some comments from Jonas. What are the high risk areas to assess in telecommunication industry audits, please? Then K-Sam said, great watching. All right, K-Sam. If you join the stream, give us a thumbs up on the video. That way we get more engagement and YouTube will be able to push the video so we can reach others. Okay, so Jonas said, what are the risk areas to assess in telecommunication industry? I'm not in telecommunication industry, so I will not be able to give you key areas in the telecommunication industry because this is more or less going to be issues about inherent risks and control risks. So it is specific to the entity that you are auditing in relation to that. So I may not be able to give you straight up items here, but one thing you have to understand is that when we are planning the audits of such company, one of the things you need to look at is the effectiveness of their internal controls. You have to look at the competition that they are in the environment. So if, for instance, we are in Ghana and MTN is declaring that, this is just an example, okay? MTN is declaring that it had made a profit of 53 billion Ghana cedis, and Vodafone is declaring that they have made a profit of maybe 43 billion Ghana cedis. Do you think Airtel Tigo will come and report that they have made a loss? No, they will not report that they have made a loss. So it could bring about a risk area where the competition is very high and the susceptibility of losing customers is very high in the telecommunication industry. How much is SIM card? Maybe 2 cedis. So it's easy. The cost of switching from one network to the other necessarily is not that expensive in relation to that. So the competition makes the area very key there. So it depends on the understanding you have of the client entity in relation to that at the planning stage of the audit. So I will not be able to give you, like I said, specific areas because I'm not really versed in that industry. Japheth Osei Frimpong, I see you. Thanks for the thumbs up. So audit planning, Charles Zuli said, what risk areas an auditor consider in auditing financial institutions? Okay, so what risk areas auditor consider in auditing financial institution? This is also an industry question related. Now, when it comes to financial institutions, one of the key areas, again, to their internal controls. Now, when we say internal controls here, what are we talking about? How do they give loans? Okay. How do they collect the loans back? How do they make money as an institution in relation to that? So these internal controls we need to find out. Then there are certain assertions in the financial statements that are risky areas we need to look out for. Items like they are loans, so that we can be able to assess non-performing loans and find out whether there is a risk that the loans will never be repaid in relation to that. So non-performing loan, and they have to be written off, but the company may decide not to write it off because it will make the balance sheet and it will make the balance statement of financial position well stand out. So these items are critical, something that we need to look out for. Then another area is them meeting the regulatory requirements by the Bank of Ghana. So we need to assess their going concern. It's a very risky area. They are cap, they are minimum capital. All of those items would have to also be considered in relation to that. So that is also something we can consider in that case. But like I say all the time, there is no golden rule. Usually, it depends on the internal controls available. It depends on the case at hand that you have to look out for in relation to that. Okay, Sam. Okay, so Sami Kote. Okay, right. You're welcome. Thank you for joining the stream. Jonas said, okay, patience. Payne still said, can we have risk areas as regards what one should consider in auditing government COVID-19 fund? I think that's an interesting question, right? So the risk areas about, okay, generally in auditing the COVID-19 fund, for instance, we need to look at the issue in relation to why the fund was established, or yes, was established there. Then the board, the executive council, whatever they call them, I forgot their name really. We need to look at them, their profile and everything, because that will help us to assess integrity and all of those things. Then we need to also look at the number of donations that were actually made into the fund. And not all, we cannot audit all the donations though, but a couple of them are quite high. Like some companies brought cars, brought cash. We need to find out whether those monies were actually paid into the uh, how do we call it, into the fund in relation to that. Then you need to also look at what this fund was spent on. Because remember, that same money is used to run the executive board, the executive council, as well as what the money is spent on. And when we are auditing anything about the public sector, value for money is very critical. So did they procure things at the lowest price? Did they so value for money, the three E's, right? Economy, efficiency, and effectiveness. So we need to also consider that on that case. So in a nutshell, yes, we need to examine how much money actually came. And there were people who paid money and mentioned they will be paying some in addition. We need to confirm whether it has actually been paid in relation to that. Then we need to find out how the people, so that we can assess the integrity of the people running the fund in relation to that. Then what has the money been spent on? Value for money, very, very critical. Because imagine you having, you see, now I'm saying this just for example, okay? Don't take it out of context. So imagine the president appoints people, and for all intents and purposes, we realize that one of the people on the board is actually somebody involved in something fraudulent in the past, embezzlement of fund, just like that, maybe at a church or at an organization. Then as an auditor, it means that the integrity of the board will be like in suspicion. So if you are going in as an auditor, that mark has to be there, that if you don't do your job well, you may be fired in relation to that. So their philosophy, their management, and what they spend the money on, these are some key areas we can look out for in auditing the COVID-19 fund. This is an interesting area though. It's an interesting area in public sector auditing in case you are doing advanced audit and assurance in relation to that. Patient said, no golden rule, and it depends on the case at hand, says Nhyira. Yeah, patience, there is no really golden rule, because the reason why I said that was that I don't want you to have something in mind, and then when you get to the exam or and the examiner throws something at you, you'll be freaking out. So it depends on the case. That is why as an auditor, you must have, or you must act with what is called professional skepticism. Be alert, be someone that has a questioning mind. And once you read the thing, you should be able to identify this is what is going on. This is what is going on in relation to that. Ebenezer Atta said, great to be here. All right. Patience said, wow, enjoying your explanation so far. Okay, Patience, that's awesome. Kelvin Kamara said, what topic will you be treating next and the time, especially on financial reporting? Kelvin, we've covered a lot of things on financial reporting to be specific. We've looked at the standards, the consolidation. So for financial reporting, I cannot confirm really, but just keep following us. You will get the details. But the time is always 4:30 p.m. or 16:30 GMT every single day. That's the time. And we post the details of our meetings on our social media platforms. So once you follow me on Facebook or Instagram, Nhyira Premium, you'll be able to get the details of our lectures in relation to that. Okay, so any other questions for me? So let's go. So number one, ethics, critical, crucial. Number two, audit planning, critical, crucial. Next one, audit procedure. And I've made some reference to this. This is a very huge area of your syllabus. Definitely there is a question in the exam hall waiting for you on audit procedures. So this is where we have actually started the audit. So how do we audit trade receivables? How do we audit trade payables? How do we audit assets? And you must understand all of these things. Now, when you're dealing with audit procedures, we are talking about the assertions. You're talking about issues like accuracy, valuation, right and obligation, cutoff. We are talking about occurrence. All of these things are various assertions that are going to be tested, and it depends on the items or the elements in the financial statement that is being audited. Trade receivables, trade payables, inventory, provisions, tax is a very huge aspect of it. So what audit procedures do we undertake? The benchmark here is that when it comes to the audit procedures, AEIOU must be at the back of your mind. That is analytical procedures, inquiry from management, inspection, observation, and then recalculation and reperformance. So these 5 things must be at the back of your mind when we are dealing with audit procedures. But it depends on the question, and you will decide what to call on in relation to that. So that is something that you need to take into consideration, but it's a conk area that is going to be coming up. Probably as we continue with this session, I may be looking at some of these things in much detail in relation to that. But you know, we are covering a lot of things on the channel, so I may not be able to really take something and really finish everything about it in relation to that. We also have the courses available online. So maybe for those of you who will be interested, you could enroll in relation to that. Jane said, good. All right, Jane. Next one, once you are carrying out the audit procedures, you are going to come across what is called audit evidence. So the next thing is audit evidence, because this is critical. When you need to gather sufficient and appropriate audit evidence in order for you to express an opinion on the financial statements. So audit evidence is very critical. Definitely there is a question waiting for you in the exam, and usually the examiner tied these two guys together, the audit procedure and the audit evidence, because when you're undertaking the audit procedures, the things that you see, the things that you come across are what I refer to as the evidence, and that has to be documented down in your audit working paper. And at the end of the audit, you find out whether you can issue a qualified opinion, an unqualified opinion, a disclaimer opinion, or an adverse opinion in relation to that. So audit evidence, something critical. Next one is reporting, my favorite area, and the examiner is going to be examining you on reporting. Reporting at this level looks at a couple of issues such as review of the audit. So before we actually issue our auditor's report, we need to review the entire audit that has been undertaken. So there's what is called a hot review, a review that is carried out prior to the issuing of the auditor's report. In relation to that, issues about subsequent events. So events after the reporting period, how do we audit that? That is in reporting. Then the issue in relation to other financial information or other information, like the director's reports, management minutes, talking about management accountants reports, all of these things, we need to audit them, we need to examine them. Then at the reporting stage also, we need to, most importantly, assess the going concern status of the organization, whether the organization can operate into the foreseeable future. And going concern is something critical, especially for advanced audit and assurance students, and the examiner may throw a jab at you. There are two things broadly you must understand when it comes to the going concern. You must understand the issues about the indicators of going concern issues, and then the mitigating factors. So if there are indicators and there are mitigating factors, then there are no more going to be any going concern issues in relation to that. But reporting is also something that the examiner is going to be throwing at you, and you're going to be careful to answer that in relation to that. So aside these 5 guys, there are a couple of other things like internal audits. Okay, this is especially highly examinable for level 2 students. Internal audits, very, very critical, very, very important in relation to that. And then the use of experts work, because as part of our audit procedures and as part of the audit evidence we are gathering, we're going to be using the work of experts. What factors do we take into consideration in using the work of experts? We must look at their independence. We have to look at their competence, their qualification. We have to look at their experience. We have to look at the assumptions that they used. We need to look at the issue in relation to why they came into that conclusion about that. So, and when it comes to the internal auditors, we need to look at, again, their organizational status, because that will help us to understand their independence. And then we need to also consider the issue in relation to their qualification, because if you have people who, with all due respect, okay, if you have people who have just finished first degree in the university and they are chief internal auditor, I mean, this guy doesn't know anything, all right? You don't know anything. You've got to be part of ICA or ACCA to be able to really understand how things are working within the organization in relation to that. So we need to understand their qualification, whether they are members of the ICAG, or maybe they are student members, or whatever it is. We need to understand all that so we can rely on their work, because whether you like it or not, as an external auditor, you're going to be relying on the work of internal auditors as well as the experts in relation to that. Then some issue about public sector audits. There is a new thing that has been introduced here for the ICA, especially exclusively, and that is accountability in the public sector. So aside talking about the role of the controller, accountant general, internal audit agency, internal audit department, and all of those things, there is public accountability as well here that you must understand. So that is also something you need to look at. Then the final thing that examiner will always talk to you about or throw a question at you is ISA 220. That is quality. ISA 220, and that is quality control of an audit of financial statements. Quality control of an audit of financial statement. Whether you like it or not, there is a question waiting for you on this, especially if you are a level 3 student doing the advanced audit and assurance in relation to that. So generally, these are some core areas that you need to focus on. There are other things like money laundering, issues in relation to professional liabilities. Yeah, you can read all of that, but these are some key areas that you need to look out for in relation to that. Okay. Any questions? Anything in the chat? You can put it in the chat for me. And let's start with a real journey for today. Audit planning, ISA 330. Pawili, I see you. Okay, so if there are any questions, you put them in the chat box for me. So when we say audit planning, what is it about? What do we mean when we say audit planning? You see, before you do everything, you've got a plan. It's the starting point. If you want to marry, you've got a plan. If you want to establish a business, you've got a plan. If you want to travel, you've got a plan. So planning is the basis for everything. But when we are talking about planning and audits in audits and assurance, what are we talking about here? In a simple language, we say that planning involves establishing the overall audit strategy for the engagement and development of an audit plan. So, audit planning involves the establishment of the overall audit strategy, establishment of the overall audit strategy for the engagement and developing an audit plan. Establishment of the overall or establishing the overall strategy, audit strategy for the engagement and developing an audit plan. It involves establishing the overall audit strategy for the engagement and developing an audit plan. So off the bat, I want you to understand this. When we talk about audit planning, it means there are two key things here. One, we have to talk about the audit strategy, because we said that it is about establishing the overall audit strategy for the engagement and then for developing the audit plan. So these are the two components of audit planning. So we have the audit strategy and we have the audit plan. But someone may ask, Nhyira, why do we plan? Now, why should we plan? Planning is critical because it plays a lot of role in the audit of the financial statements. So a couple of things we can mention about the benefits of planning the audit of financial statements can include the following. One, when the audit is planned, it helps the auditor to devote appropriate attention to important areas of the audit. So it assists or helps the auditor to devote appropriate attention to important areas of the audit. So there are going to be key areas of the audit. So in order for the auditor to be able to devote appropriate attention, appropriate resources to those areas, planning assists him to be able to do that in relation to that. Another thing about the importance of planning that we can talk about is that planning assists in the selection of the engagement team members. Okay? It assists in the selection of the engagement team members. Because you see, at the planning stage, we will understand the client entity. We will understand the internal controls. We will assess the risks of material misstatement. We will understand what is happening, what is going on, what is good, what is bad, what is evil, and what is not good. So based on that, we can now decide which people should we have on the audit team. Should we have an IT expert? Should we have a tax expert? Should we have a valuer? Should we have somebody who is an expert in valuation of estates? Somebody who is an expert in valuing intellectual properties? So planning the audit helps in the selection of the engagement team members in relation to that. Again, planning the audit also facilitates the direction and supervision of engagement team members. Direction and supervision of engagement team members. Direction and supervision of engagement team members. Because when we plan the audit, as you will look at later on, one of the components of audit strategy is direction of the audit. So once we plan the audit, we will be able to now know what to do, how to do, who is doing what, and who is responding to what or reporting to who in relation to that. So that is also another reason or benefit of adequate planning of the audit of financial statements in relation to that. Then another important we may talk about is also the issue in relation to organizing and managing the audit team members for effective and efficient audit. So planning the audit enhances, in a nutshell, that a quality audit will be undertaken. This is very, very critical. Now, what is a quality audit? A quality audit is an audit that is undertaken by the right caliber of audit team members to arrive at a reasonable conclusion in relation to that. So to enhance quality audits, when we plan the audit, we are able to select the team members. We will identify the key areas to pay attention to. We will know the direction of the audit. We will know who is responsible for what and how to review each person's work. So in a nutshell, we are going to be undertaking what? A quality audit in relation to that. So these are a couple of importance that we can talk about in relation to or benefits of undertaking the audits in that case. In addition to looking at the benefits, if you have any questions, please put them in the chat box for me. If you have any questions, you put it in the chat box for me. Now, aside these benefits, there are also what is called objectives of planning and audit. Now, usually they are used interchangeably because the objectives, just like the importance just like the objectives in relation to that. But I'm going to share with you, among other things, 3 core objectives of planning and audits. So objectives of planning and audits. Okay, Patience said, please redefine quality audit. Right, so what I mentioned about quality audit is that, in a nutshell, Mustafa said, what about audit materiality at the time of planning stage? I mentioned materiality as part of planning. We will talk about that in a moment, Mustafa, don't worry. Yeah, right. So Patience, quality audit. I mentioned that in a simple language, we can say that quality audit is an audit carried out by the right caliber of the audit team to arrive at a reasonable conclusion of the audit. So if we carry out the audit using the right caliber of team members based on our understanding of the client entity, all other things being equal, we are going to come to a reasonable conclusion in relation to that. There are other things about quality audits, Patience, that you must understand. I'm not talking about it really deeply here though, but quality audit has to do with the procedures that we undertake. Is it about inquiry or maybe observation? Is it about management representation or inspection of documents? So quality audits has another deeper level of explanation that we may look at later on, probably as we continue with the discussion. But in a simple language, it means that carrying out the audit in such a way that you will be able to come to a reasonable conclusion and issue a reasonable audit opinion in relation to that. So at the end of the day, things don't start smelling. Okay, like the banks, auditors will issue an unqualified opinion to say everything is fine. Then just 6 months after that, the bank is collapsing in relation to that. So that means a quality audit wasn't undertaken in relation to that. And like I mentioned, quality includes a lot of things, how you under the procedure you are putting in place, the people there, they are independent in relation to that. Okay, patients, you are welcome. So I'm going to give you three key objectives of audit planning, three key objectives of audit planning. I've mentioned this already in the importance, but I'm going to talk about it again here because it's part of the objectives. One, to ensure that appropriate attention is devoted to the different areas of the audit. To ensure that appropriate attention is devoted to the different areas of the audit. So that's one of the objectives of planning the audit, because we want to find out, whoa, what are the risky areas in the financial statements? What are the risky areas in the organization? Is it their trade receivables? Is it their trade payables? Is it that the COO is bondelism and cannot do tax returns? So we need to look at their tax very well and bring in a tax expert that can be able to identify the issue. So that is the first thing, to ensure that appropriate attention is devoted to the different areas of the audit, especially the key areas of the audit. Two, to ensure that potential problems are identified. To ensure that potential problems are identified. To ensure that potential problems are identified. This is what we mean by risks of material misstatement. And I'll be talking about it later on as we continue. What could go wrong? If we plan our audit very well, we will be able to know the potential problems, what could go wrong, what is likely to go wrong. So if management integrity is in jeopardy, internal controls are not effective and efficient, then we should expect that there will be errors. If the COO is somebody who has charted like 7, 8 years ago and has never attended any CPD, then we should expect that there could be a lot of misstatement in the financial statement. If the company leases a lot of its assets, then we should expect that there may be a lot of off-balance sheet and misappropriation and a lot of errors about how they are going to apply IFRS 16 as compared to IAS 17. So when we plan the audit, it helps us to ensure that potential problems are identified. Because if you know ahead what is likely to happen, when you get there, you become more vigilant, you become very alert, and you'll be able to fish out things as and when they come up. And the last one that I will talk to you about in relation to your objectives of planning an audit is to facilitate review. To facilitate review. To facilitate review. Because you see, at the end of the day, like I told you earlier, when we finish the audit, we need to review everything. All right, the audit working paper, we need to examine everything. There is a hot review that is undertaken to find out if really the audit evidence we've gathered are sufficient and appropriate for the item that is being audited in relation to that. So to facilitate our review, it is very important to look at the issue in relation to audit planning. So these are the things we can talk about in relation to objectives of audit. Any questions, please, in the chat box for me. If you joined the stream, give us a thumbs up on the video and then share the video as well with your friends on WhatsApp, Telegram, Facebook, whatever it is, so that we can get more people coming to watch the stream and also get access to other contents on the channel in relation to that. So any questions for me? Put it in the chat box. So let's go now into the detail. If you have not been serious with me all this while, I want you to be damn serious now because we are about to really begin what audit planning is about. So let's go. Now, remember I told you in the beginning that there are two components of audit planning. Two components. So when it comes to audit planning, there are two components: the audit strategy and the audit plan. Please listen carefully. There are two components of audit planning: the audit strategy and the audit plan. What is the difference between the audit strategy and the audit plan? Very, very important. Foster Basius. Wow, I'm late. Oh, yeah, Foster. Today you are very late. But don't worry, you can still follow and watch the playback of what you mixed earlier. Sorry, later. So, what is the difference between an audit plan and an audit strategy? Listen to this carefully. So, the audit plan is the detailed procedure that the audit is going to be undertaken. The audit detailed procedure to be undertaken for the entire audit. That is the audit plan. I'm going to come back to that in a moment. The audit strategy refers to the overall approach of the audit. So strategy is about approach, plan is about procedure. So the audit plan is going to tell us issues like, from here, you do this, you do that, you do that, you do this, that kind of thing. That's your plan. The strategy has to do with your approach. Are you getting it? The methodology you're going to be using on the audit in relation to that. Now, the audit approach depends on a number of things that we need to understand in relation to that. So let's first look at the audit strategy, and then we will look at the second component, audit plan, and I'll come back to these things in relation to that. So let's go. Audit strategy. So that is the first component of audit planning. So audit strategy refers or relates to the overall approach of the audit. The overall approach of the audit. Now, there are key elements of the audit strategy. There are key elements of the audit strategy. So what are these key elements? So let me share my board a little bit. Then let me put elements here. So let's look at the elements. Now, what are the elements of the audit strategy? Number one is what is referred to as audit scope. So the scope of the audit, the scope of the audit. Now, when we say audit scope, what do we mean? This refers to the amount of time and documents which are involved in an audit. This is an important factor in all auditing, the audit scope. So in a simple language, we are saying that this refers to the amount of time and documents which are involved in an audit. So when we talk about the audit scope, we are trying to answer the question, how much work is involved? How much work is involved? That is what we mean by the scope of the audit, the time and the documents which are involved in the audit. That is the first element of audit strategy. Number 2, timing. Now, when we say timing, this refers to when to start and end the audit, as well as the time of visits. Now, you've got to understand that at the planning stage of the audit, you have to decide all of these things. Okay, so when are we starting the audit? When are we ending the audit? Now, why is this important? This is important so that we can't or we don't interact or interfere with the day-to-day running of the organization. And then number 2, we will know the number of people that we will need on the audit. Now, so let me give you an example. On the average, usually what happens is that an audit may take like say 3 months. But a company can employ an audit firm and say, hey, listen, we want you to finish the audit in a month because we are preparing to be listed on the stock exchange, or we are actually arranging to go for a loan in relation to that. So we are planning to go for a loan. So we need the audited financial statements as soon as possible. So we must understand, when are we starting the audit? When are we finishing the audit? Or when are we ending the audit? Not only that, when are we visiting and communicating with those charged with the governance? Because whether you like it or not, there are some key people we need to speak to during our audit. We need to speak to the COO, we need to speak to the CFO, we need to speak to the CMO, and all the CCC, the CEO, the board chairman, chief operating officer, all of the guys, we need to speak to all of them in relation to that. But the question is, you must tell them ahead of time when you will be coming so that they can make time available for you. Because if you go to the firm and they are not aware you are coming, they can be relaxed on whatever questions you want to ask them because you are interfering with their day-to-day running as an organization in relation to that. So the first element is the scope of the audit, how much work to be done. Second thing is the timing, which is when we are to start the audit and to end the audit, as well as the time to visit. That's the second element of audit strategy. The third element will blow your mind, and that is the key area that I've been talking about all this while, and that is called the direction of the audit. That is the third element, the direction of the audit. Now, when we talk about the direction of the audit, this simply refers to how to undertake the audit. How to undertake the audit. That is what we mean by the direction of the audit. Please note that the direction of the audit depends on 2 things. Please listen to me carefully. The direction of the audit depends on 2 key things. Number 1, understanding the client's company, and number 2, the materiality level. So there are 2 things that decide or that determines the direction of the audit, that determines how we're going to be undertaking the audit. And these are understanding the client entity, and then number 2, materiality level. So let's look at the first one, understanding the client entity. So understanding the client. That's the first thing under direction of the audit. If you have any questions, you know what to do. You put it in the chat box for me in relation to that. Now, according to ISA 315, that is assessing the risks of material misstatement by understanding the client entity, there are 5 things to do or understand about a client in order to assess the risks of material misstatements. In other words, If we are determining the direction of the audit and we want to find out how we can assess the risks of material misstatement, according to ISA 315, assessing the risks of material misstatement by understanding the client entity, there are 5 things about the entity we need to understand. Then based on how and our understanding of these 5 things about the company, we can now assess the risks of material misstatement. So what are these 5 things? Number 1, internal controls. Very critical. So the internal control system. That is the first thing we need to understand about a client entity. Now, what are internal controls, or what is an internal control system of an organization? The internal control system refers to the processes, procedures, and activities designed and implemented by the management and those charged with governance to enable them prepare reliable financial statements. Let me take that again. The internal control system refers to the processes, procedures, and activities designed and implemented by the management and those charged with governance to enable them prepare reliable financial statements. In a simple language, the internal control system simply states how we do things in the organization. So if we want to understand how things are done in the organization, we need to understand their internal controls. There are times when, if you're an auditor and you go to a company, every well-structured organization has what is called internal control framework manual. So they have a manual there that tells you how everything is done within the organization. So when you're an auditor, for you to understand how things are done in the organization, you got to read that manual. You got to read that structure. When I say manual, it doesn't mean it is like voluminous, right? But it tells you how things are done within the organization on a regular basis in relation to that. But the key question we need to ask ourselves is, why do we have to understand the internal control systems? Because it is out of the internal control systems that the financial statements are prepared. So whatever figure you see on the face of the financial statement did not come from a thin air, but comes as a result of the internal control systems. So the sales figure you see there, the cost of sales you see there, the other income you see there, the distribution cost you see there, the tax you see there, all of these things are from the internal control system. So you must understand the internal control system, and then you can assess whether the internal control systems are working well or they are not working well. Now, if you are doing audit and assurance level 2, internal controls is another topic that you have to look at. There are elements of internal controls that you need to look out for, because we need to understand who the managements are, the philosophy of management, their management style. We need to understand the accounting policies, accounting systems that they are using. We need to understand even the softwares, the programs that they are using. We need to even understand the qualification, expertise of the accountants, the COO, the CMO, and all of those things. All of these forms part of the internal control. So according to ISA 315, assessing the risks of material misstatement by understanding the client entity, the first thing we must understand is how are things done in the organization. That answer will be derived from assessing or understanding the internal controls in the organization. One of the things that we can also do about understanding of the internal controls is to ask management whether bank reconciliation statements are prepared regularly in relation to that. Because every good internal control system in a well-structured organization means that they should be preparing bank reconciliation statements on a regular basis. So if they are not preparing bank reconciliation statements on a regular basis, then there is a risk that cash balance may be overstated. So that is the first thing we need to understand when it comes to the internal controls, or sorry, when it comes to the client. Any questions? I believe you are following me so far. Any questions, you can put them in the chat box. The second thing we need to understand about the client entity is what is referred to as external factors. External factors. Now, the internal controls system is there within the organization, okay, within the confine, within the four walls of the organization. But in addition to what is going on, how things are done within the organization, we must also understand what is happening outside the organization. So when we say understanding external factors, we are talking about the industry, we are talking about laws, we are talking about competition. Are you getting it? All these forms part of the external factors. So these are the factors that are in the environment or industry of the organization or client, which may cause management to be involved in some fraud or misstatement. So factors which are within the industry, forces which are within the industry, which may cause management to be involved in some fraud or to be involved in some material misstatement, are the external factors. But someone may ask, Nhyira, when you talk about these external factors, what kind of external factors are we talking about here? There are a lot of external factors we could talk about, but I'm going to give you a number of them. The first external factor that we can assess is about competition. Okay, I see a comment coming from Patience Pinstel. She said, please come again with why management would want to reduce the length of an audit apart from wanting to float shares on the stock exchange. Okay, so like I mentioned, maybe they want to float shares. I don't think I mentioned that, but they want to float shares is one of the reasons, or they are going for a loan from the bank, or there is a potential acquisition arrangement or merger arrangement. That could also be a reason why they will reduce the length of the audit in relation to that. Or they are bidding for a contract from an international organization or even from the government, and they are requesting that they bring a current audited financial statement. So these are also some reasons we can talk about patience when it comes to reducing the length of time in relation to that. You know, it's not something that is done intentionally by management. It's done by management because there is something urgent at hand. Maybe they want to be listed, they want to take a loan, it's a merger arrangement or it's an acquisition arrangement, or they want to bid for a contract. But the most serious aspect is not whether the management is reducing the length of time, but is whether the audit firm can undertake a quality audit. Because if usually we have to take 3 months, and now the firm says we should use 1 month, that means we must increase the number of people to be engaged on the audit, and we must make sure we undertake a quality audit in relation to that. So that is it in that case. Noted with thanks. You're welcome. All right. So understanding the client's entity, number one, internal control system. Number two, external factors. So what external factors will we be interested in as auditors? The first one is competition. Remember I spoke about this earlier. Now, when the competition within the industry is high, this may reduce the profitability of the client entity. Definitely, because competition is intense, competition is very tough, very high within the industry. That means that profitability of the client entity may reduce. As such, since management also wants to satisfy the shareholders and put the organization in the right standing, they may try to overstate probably the closing inventory. They may try to manipulate financial statements in relation to that. And this could result into the risk of material misstatements. I hope you are getting what we're saying here. So for instance, let's say that we have, I'm going to use another illustration here. Let's say we are a manufacturing company and we sell beverages like that. Let's see. Yeah, let's say we sell beverages. And you see the beverage industry or sector in this country is very fierce. There are a lot of brands selling a lot of beverages, sugary beverages in relation to that. So let's say we also enter into that. It's a very competitive area. And so we want to also satisfy our shareholders. So at the end of the year, if you realize that the profit we've made is too small, what do we have to do? We may overstate inventories, we may understate expenses, we may decide not to depreciate assets, we may decide to do a lot of things so that we can put the financial statements in a good picture. This is what leads to what is called creative accounting. Are you getting it? Window dressing and all of those things. Now, it doesn't mean management, now professionally it means management is not behaving well because they are lying, their integrity is impaired here. But if competition is high, there is a risk of material misstatement in relation to that. That is why we must assess the competitive environment of the industry as auditors. Then I see a comment coming from Mustafa. How does the auditor react if the management is using delaying tactics and providing information late, resulting in delay in completion of the audit? Okay. As always, three things. Number one, you must confront the issue and tell management and ask them why they are delaying. Now, if you ask management question, if the auditor requests something, make an inquiry from management or wants a management representation on something and management is delaying, that could be an indication of risks of material misstatement. That could tell us to really understand that there are a lot of things management is hiding in relation to that. So number one, we can confront the issue. Talk to management. What you're doing is not good. We want the information as soon as possible. Number two, you can seek legal advice, either legal advice or advice from your audit firm. So you got to report the issue to your audit firm and tell your audit firm about this. Then they will decide what must be done. But if you realize that still the delaying tactics is getting out of hand, you can resign from the audit in relation to that. So that is what you can do, Mustafa, in that case. The second thing that we need to understand as external factors is laws and regulations. Laws and regulations. It's very important to understand the laws, the regulations, the acts, the enactments that governs a particular industry. So if we are auditing a financial institution, there are laws, there are acts, regulations, directives that guides the financial sector by the regulatory body, Bank of Ghana. So we must understand what is the law there. Now, if there is or when there is a likelihood of a new law, coming into it or affecting, which is going to affect the industry's operation in relation to that, then it means that possibly the entity may have to make some provisions for potential liabilities in relation to that. But remember, when you make provisions in accordance with IAS 37, profit is going to reduce. Again, if we know there is a new act that is coming on, that could affect the going concern status of the company, that will also help us to issue a reasonable audit opinion in relation to that. So like for instance, when the minimum capital was increased from 120 million Ghana cedis to 400 million Ghana cedis for the banks in Ghana, when we are auditing the firms before that became due, we need to find out whether the firm can actually meet the new minimum capital. If the firm cannot meet the new minimum capital, it's a going concern indication. So it means that the financial statement would have to be prepared on a breakup basis in relation to that. So we must understand the laws and the regulations that governs the industry in relation to that. Then another external factor that we need to look at is the issue about provisions and disclosures. Disclosures and provisions. Now, there may be risks of material misstatement on the disclosures of transactions in the financial statement of the client, as well as provisions of the value that we need to look out for in relation to that. Patience said, please go over the laws and regulations. Okay. What I said about the laws and regulations is that as auditors, we must understand the laws, the rules, the acts, the regulations that governs the industry within which the client entity is in. For instance, when there is a likelihood of a new law or regulation in the industry or governing that particular industry, then the activity of the company may not be conforming to that rule or to that new act. This means that it may result into some liability, which means the entity must recognize or make some provision for contingent liabilities in relation to that. Then I illustrated something to say that, for instance, when the minimum capital of the banks was increased, they were given an ample time. And the deadline was, I think, was it 2018 December or 2017? I think 2018 December, something like that. So if we were auditing the financial statement for that year, we must assess whether the company can meet the minimum capital requirements. Are you getting it? Because it's a law that is coming to pass. So if they cannot meet, then the financial statement will have to prepare on a breakup basis and not a going concern basis. So we must understand the laws, the rules, the act, because that will help us to understand how they are preparing the financial statements and whether the financial statements are actually in line with the laws and any future changes that are coming in relation to that. Patience, you good? And the third thing is disclosures and provisions. You see, there could be some external factors about disclosures and provisions. Okay, so there may be risks of material misstatement on the disclosure of transactions. You see, when it comes to auditing, one issue that you must understand is related party transaction. You are welcome, patience. Related party transactions. There will always be related party transactions, but the entity may refuse to disclose it. So we as auditors must find out if there are any related party transactions and how we can examine them. This is one of the difficult areas of auditing, related party, because unless the management tells you or you figure out a transaction and find out the way the transaction took place, you need a higher level of understanding and a high level of professional skepticism to be able to identify. Now, when it comes to related party transaction, the materiality level is not just about the amount, but the nature. So since the transaction happened between related parties, even if there is no monetary value, there has to be a disclosure. So what is a related party, for instance? So let's say I have a company and then Patience is on the board of my company, and Patience also has a company in relation to that. So let's say that I'm into education. Let's say Patience is in IT. So her firm is an IT firm and she's on the board of our company in relation to that. Okay, so when we want any IT services, that is for our devices, our laptops, our cameras, whatever it is, we go and buy it from them. Then there was a time that we had a problem about some of our systems, and Patience said, oh, the guy should come and fix it for us. And we were supposed to pay $3,000, but Patience said, oh, it's not anything, we should not pay anything. Now, that is not a free transaction, right? It is important that we disclose in the books that that transaction took place, but it was rendered by Patient's company and they did not charge us anything. It's a disclosure requirement that must be made in relation to that. But sometimes we may decide not to do it. So we may decide to still write it as though we paid, so that I'll put the 3,000 in my pocket in relation to that. Again, when you are an auditor and you find out something like that, the integrity of management, again, is in jeopardy here, because it tells you that maybe that's not the only item they are involved in. They could also be involved in other things in relation to that. So these are the three things that we must understand in relation to the external factors. Remember what we are looking at generally. We are looking at the audit strategy, and we look at the first element, the scope of the audit, how much work is supposed to be done. Number two, the timing of the audit, when to start, end the audit, as well as when to visit and communicate with management and those charged with governance. Number three is the direction of the audit. And we said the direction of the audit has to do with how to undertake the audit. And we said the direction of the audit depends on two things: the understanding of the clients and materiality levels. So we're looking at the first aspect of the direction of the audit, and that is understanding the client entity. And we mentioned that when it comes to understanding the client entity, according to ISA 350, assessing the risks of material misstatement by understanding the client entity, there are 5 things we must understand about the client entity. The first one is internal controls. We've spoken about that. And the second one is the external factors in relation to that. Number 3. Any questions, you put it in the chat for me. The third thing we need to understand about the client entity is the structure and accounting policy. So understanding the structure and accounting policy. This is very critical. The structure of the client's business will affect how, or will affect the risk of material misstatement of the organization. Now, when we say the structure of the company, what are we talking about? We are not just talking about the organizational structure as to who the board, like the CFO, the department. We are also talking about the location, geographical location. If the company has branches across the globe, Asia, Africa, Europe, that means, and we are auditing the consolidated financial statement, then there may be a risk of material misstatement due to some inherent risks. It's very, very important. Then that will also tell us that the accounting policies are going to be complex. because the accounting, even though we are all using IASs and IFRSs, recognition of certain items in Asia, in the US, in the UK is or are different, may be different from how they are recognized in Ghana in relation to that. So if that is the structure of the company and we are auditing the consolidated financial statement, it means that there could be a lot of inherent risks and the accounting systems may be complex. But if it is just some mom and pop company, or they have one branch in Accra, another branch in Kumasi, another branch in Takrade, I mean, that one is not too dangerous. Yeah. So we can go ahead in relation to that. But what we're saying here is that we need to understand the structure and the accounting policy, because usually the structure tells what kind of accounting policies we're going to be dealing with in relation to that. That's the third thing we need to understand about the client entity. Number 4, company's performance. Company's performance measurements. Company's performance measurements. This is a very critical area as auditors that we need to look at. How the client's company assesses the performance of management to pay bonuses affects how financial statements will be prepared. So if management bonuses are tied to the financial statement, to the profit that we make, that means there could be a lot of what? Risks of material misstatement. Like the question we were looking at yesterday, where management bonus was tied to the profitability of the company, and we realized that during the year, they were rarely meeting their targets. For that reason, the COO was warning the accountants not to make certain provisions, not to recognize certain items on the face of the financial statement. So if management performance is going to be assessed by looking at the financial statements, then there will be a lot of errors. There will be a lot of errors in relation to that, because if at the end of the day things are not going on well, they may fictitiously or cook a couple of things into the financial statement, some window dressing, some creative accounting, and do a lot of things just to make sure that the figures are well on the financial statement so they can make their profit. Because if, for instance, they are promised that if profit before tax increases by 20%, and they realize that their profit before tax has increased by only 15%, that means they will miss their bonus. So in order for them to get the bonus, they can do a lot of things so that before you realize it, now the profit before tax is somewhere around 32%. Then they will say, hooray, but the hooray is all lie. But we need to understand that as auditors, how the client is assessing the performance of management to pay bonus. That's the fourth thing we need to understand. Then the last one, which is my favorite area, is the issue about the company's strategy, business plan, and related business risks. The company's strategy, business plan, and related business risks. Company strategy, business plan, and related business risks. Now, why is this important? Why is this important? You see, the client's company wants to gain competitive advantage within the industry of operation. As such, it will devise a lot of strategies to gain the competitive advantage, and will have a business plan to execute the business strategy. Because at the end of the day, every company wants to gain competitive advantage. All right, every company wants to be number one. Every company wants to have the largest or the highest share in the market. So for that reason, they will design a business plan to execute the strategy. For example, the client's company may have a strategy to become the market leader in the industry. Now, the business plan may be to diversify in order to become the market leader. Now, when we say to diversify and become a market leader, what do we mean? We mean, for instance, by opening new markets, new outlets, and reaching new customers. Now, as a result of the new markets, the new market may fail. So for instance, we want to become, let's say, let me use a practical example. So let's say our company, Premium Education Hub, we want to become the leaders in education service, professional education service provision in Ghana. And currently we have our campus at Dacoman. Then all of a sudden, we go and open another branch at Kaswa. We open another branch at Nima. We open another branch at Takrade. We open another branch because we want to become leaders. Now, do you think all of the outlets we open will actually be making money? No, certainly there could be some failure. Now, when there are failures like that, it means that the cost will rise and revenue will fall below expectation. Now, when your cost goes up and your revenue falls below expectation, that means that there will be a risk of material misstatement in the profit due to overstatement of probably closing inventory, overstatement of other items, or understatement of certain costs in relation to that. So this is why we need to understand what is the strategy of the company, what business plans do they have, and what are the related business risks that they are exposed to. When we understand this, we will be able to determine whether things are right, things are wrong, things are going on well, or things are not going on well in relation to that. So that is the concept about the 5 things we need to understand about the client entity. Jane said, could you explain well how auditor set materiality level? We are coming to that, Jane, so stay with me. We are coming to that in a moment. So according to ISA 315, these are the 5 things we need to understand about a client entity. Any questions, please put it in the chat box for me. So number 1, the internal control systems. Number 2, the external factors. Number 3, structure and accounting policy. Number 4, the company's performance measurement. And number 5, the business plan or the business strategy or the company strategy, business plan, and the related business risk. But there is a big question we ask about this. These are the 5 things we need to note. But this is the big question we ask. What is the big question? The big question is this: how can the auditor assess the risks of material misstatement by understanding the client's entity? How? How does he, how will we know about the internal controls? How can we know about the external factors? How can we determine the strategy, the structure of the organization? How can we understand the business plan? How? That's the big question. How can the auditor assess the risks of material misstatement by understanding the client entity? How? The answer to that big question is what we've been talking about all this while. So the answer to the big question, to enable the auditor to assess the risks of material misstatement by understanding see this. So to enable the auditor to assess the risks of material misstatement by understanding the client, the auditor carries out the audit procedures. So how can the auditor understand the client entity or assess the risks of material misstatement by understanding the client entity? How can the auditor do that? The auditor will achieve that by carrying out what? The audit procedures. And we've already spoken about audit procedures. That is analytical procedures, the AEIOU. Analytical procedures. Now, in a simple language, analytical procedures simply has to do with at the planning stage. Note that analytical procedures goes through the entire stage of the audit or through the entire audit because we apply it at the planning stage of the audit. It is done throughout the audit and it's also done at the review of the audit in relation to that. But in a simple language, analytical procedure simply has to do with comparing of the current year financial statement to previous year financial statements, budgets and forecast, industry information, and other information in order for us to identify trend changes in relation to that. Not only that, to understand the client entity and to assess the risks of material misstatement, we can make inquiry from management. That is why I told you earlier, we could ask management, when was the last time or how often do you prepare your bank reconciliation statement? If they say, we prepare bank reconciliation statement every 4 months, that's serious because at least at the end of every month, a bank reconciliation statement has to be prepared. So if they say they are preparing bank reconciliation statement every 4 months, then there could be error there. The risk of material misstatement of cash balance being misstated is high in relation to that. So we can inquire from management. Then next thing has to do with inspection of specific documents. Like for instance, I told you well-structured companies may have an internal control manual, internal control framework manual, which when you are an auditor and you get there, it will be given to you and you will read it and understand how the management says things are working well in the organization. Then O has to do with observation. So you have to see yourself and find out what management says, what management told you. Is that what is really happening? So you need to observe a process. When a customer comes to the company, how do they render the service? If somebody wants to buy goods on credit, what happens? So sometimes we can put a dummy transaction into the internal control process to find out whether it will go through the entire stages that it has to go through. That is also there. Then sometimes we need to do some recalculation or reperformance to really understand what is happening in relation to that. So how does the auditor assess the risks of material misstatement? By understanding the client entity. The answer is that the auditor carried out the audit procedures at the planning stage of the audit. Any questions for me? Any questions? Okay. So that is the first part of the direction of the audit, understanding the client entity. So once we understand the client entity, we come to Jane, your question, and that is materiality. So materiality level. Materiality level. Any questions, please put it in the chat box for me. Any questions, put it in the chat box. Now, materiality is concerned not just with the size or the value, but also with the nature of the matter and circumstances of the entity. So something is material when its omission or misstatement individually or in aggregate will be able to influence the economic decisions of users of the financial statement. So if something's misstatement, omission, either as a single item or when we bring them together, will influence the economic decisions of the users of the financial statement, then we consider that thing to be material. But remember, we are saying that materiality is not only about the value, okay, or the size of the transaction, but also the nature of the transaction. That is why I mentioned earlier, when it comes to related party transaction, yes, there may be no value involved, there may be no money involved, but because it's a related party transaction, it is material and has to be disclosed in relation to that. Patient said, the U in the REIF in the audit procedure, what does it represent? Okay, so Jane has answered you. It represents recalculation and reperformance. Okay. Now, materiality generally can be seen in two ways. Materiality generally can be seen in two ways. So we have preliminary materiality level and then performance materiality level. So I want you to be careful about this because there's a very huge aspect in relation to that. So number one, when we are starting our audits at the planning stage, we have understood the client entity. So now we are setting the materiality level. What should be material? What should not be material? What we should investigate into and what we should not investigate into. So there are two things or two ways for us to see materiality. The first one is called preliminary materiality. So preliminary materiality level. Now, this is the materiality level that is set for the financial statement as a whole at the planning stage of the audit. Okay, so when the auditor understands the client entity based on the internal controls, based on the external factors, for the financial statement as a whole, the auditor will set the level of materiality. Now, the level of materiality set at the planning stage will always be a matter of professional judgment. Again, there is no generally accepted rule here, but in practice, it is always based on professional judgment. So it is based on the understanding of the client entity. It is based on the risks that the auditor has identified. It is based on the effectiveness and efficiency of the internal controls that will assist the auditor in setting the materiality level. But there is a benchmark criteria for guidance that has been set that we can follow. For example, we say that at the materiality level, at the planning stage of the audit, we will say that, okay, anything that is between 0.5% and 1% turnover. Turnover is the same as sales, right? Could be material or anything between 1% and 2% of net assets, maybe material. Anything 0.5% and 1% of gross profit, maybe material. So this is just a guideline, okay? If the thing is between 1% or 0.5 and 1% of the sales, then we say it is material to the statement of comprehensive income. So the income statement and other comprehensive income, we will say the thing is material to it in relation to that. Now, if the thing is between 1 and 2% of the net asset, then we may say it is material to the statement of financial position. So this is just a guiding benchmark that can be used. Usually in the exam hall, you are expected to also come with this as well on the average so that you can determine the materiality level of an item in relation to that. Now, if using the benchmark approach, the auditor must consider a couple of factors. Number one, the elements of the financial statements, and then whether there are matters upon which users are likely to focus on, then the nature of the entity, its life cycles, and the industry that it is in. It will also be considered when setting this and using this benchmark. And then the ownership structure of the firm and the way the entity is financed, that is also something we need to look at there. And then as well, the changes that may occur in relation to that. So let me give you a couple of examples practically on how this preliminary materiality thing is done. So let's look at an example about this. So if a balance is 5% of total assets and 0.3% of revenue, so it's 5% of total assets, it's 0.3% of total revenue, and it's 6% of profit before tax. Is the amount material to the financial statement, or sorry, to the statement of financial position? Yes, if you check, it is 5% of the total asset. So when it comes to the statement of financial position, it's material, okay? It's material because our benchmark is 1 to 2%, and it's 5%, so it exceeds. 2, is the item material to the statement of comprehensive income? Yes, it is material to the statement of comprehensive income because again here we are seeing that it is exceeding the 5% of the profit before tax. It is 6% here. So it is material to the statement of comprehensive income in relation to that. Now, if a balance is 0.3% of revenue, is it material? No, in this case, it's not material because it does not exceed the 0.5% of the total revenue the auditor has set in relation to that. So this is how we determine the issue about preliminary materiality. The core thing you must understand about this is that the preliminary materiality is what is set for the whole financial statement at the planning stage of the audit. Any questions? Okay. So after we understand the client entity understand whatever that is going on in the client entity. The next thing we look out for is the issue in relation to performance materiality. So the second aspect of materiality is performance materiality. So what is performance materiality? This is the materiality level that the auditor sets when performing the audit work, which is quite below the preliminary materiality level. Listen carefully. The performance materiality is the materiality level that the auditor sets when performing the audit, which is quite below the preliminary materiality level. So at the planning stage, the auditor sets the preliminary materiality, and that is for the whole financial statement. But now when the auditor is performing the audit, is undertaking the audit, he will set another materiality level for the various aspects of the audit. And usually that is quite below the preliminary materiality. The objective here is that so that anything that is in the brackets of the preliminary and the performance will be considered to be material in relation to that. So for instance, if the auditor sets the preliminary materiality level to say 8%, he would then set the performance materiality level to say 5%. Okay, so preliminary materiality level 8%. Then for the performance, it will be quite lower to say 5%. The idea here is that any amount between this will be considered as material and will require more audit procedure to be undertaken in relation to that. So this is what you got to understand about the performance materiality level. But note this, I've mentioned it already, but I want you to note it as well in relation to that. The levels chosen for materiality, for preliminary materiality and performance materiality would depend on the confidence the auditor has in the client's figures. In other words, it depends always on the judgment of the auditor. It depends on their understanding of the client entity. It depends on the effectiveness and the efficiency of the internal controls of the organization. This will guide the auditor in setting the preliminary materiality level and then the performance materiality level in relation to that. So, in putting that into perspective, we will say that the materiality level will impact three key areas that we need to look out for. The first one is the nature and the extent of the audit test we need to undertake. The second one is whether to seek any adjustments to the financial statement based on the materiality level we've set. And then the third one is the degree of any audit qualification if necessary. So the materiality level will affect three key things. Number one, the nature and the extent of the audit test to be undertaken. So the audit test to be undertaken, the nature and the extent. Okay, what kind of, do we need to inquire? Do we need to inspect? Do we need to observe? What do we have to do in relation to that? So we have to look at that. Number two, the materiality level will affect whether we need to look at adjustments to the financial statements. Because if we realize that there are a lot of misstatements in the financial statement, then there could be some adjustments. Then we need to also determine the materiality level will also affect us in terms of our audit reports qualification in relation to that. So these are the three key areas that the materiality of the audit is going to be impacting in relation to that. Now we will look later into the issue about materiality and assessing the risks of material misstatement, the audit risks, the inherent risks, the control risks. We'll look at all of these much later on in relation to that. So what have we discussed so far? This strategy, audit strategy, we've looked at the scope, how much work is involved, the timing, when to start and finish the audit, and then the direction of the audit, which is made up of two components, the that is understanding the client entity and then the materiality level in relation to that. Any questions for me real quick? Any questions for me? Any question? Okay, so let's look at the next item, and that will be number 4 of the elements of audit strategy. And so that will be the nature. So scope, timing, direction. Number 4 is the nature of the audit. Now, the nature of the audit is that we are performing an audit either as per international audit standards or international standards on review engagement. So the nature of the audits can be either we are performing the audit in accordance with ISA's, International Standards on Auditing, or the ISRI, that is the International Standards on Review Engagement. Because if we are performing the audit in accordance with the ISAs, that means that we need to be looking at the kind of opinion that we are going to be issuing and the kind of assurance that we are going to be giving. If we are undertaking the audit as per ISAs, then we are going to be giving a positive assurance. But if it is in accordance with ISRIs, then we are going to be giving negative assurance. Now, when we say positive assurance, what do we mean? It means the auditor has performed a lot of work, a lot of audit work, and it will usually take the audit team about 3 to 4 months to complete the audit work. So that is a general audit in relation to that. But if it is a review engagement that the auditor is undertaking in relation to that, that means that the auditor hasn't done a lot of work and usually takes a short time. So it means that the audit team did less work in relation to that. So as auditors, we must also determine the nature of the audit. That's the 4th thing that determines the audit strategy. And then the last one is the purpose. Why are we undertaking the audit? Now, the auditor must determine why the audit work is being carried out. Now, the reason for the audit to the audit firm may be business common sense. The audit firm wants to make money, and the audit firm must ensure that ethical issues are appropriately dealt with in the audit in relation to that. So these are the 5 elements of the audit strategy. Any questions? Any questions? Okay. So I'm gonna be concluding somewhere around here today. And tomorrow we're going to be continuing with part 2 of the audit planning, and we'll look at the audit plan. and we look at the audit risks, the components of audit risks, uh, inherent risks, control risks, detection risks, and how all of those things are done in relation to that. So I'm going to conclude here today. If you have any questions, please put them in the chat box and I can answer them before we sign off for the day. So what we've been looking at is the issue about audit planning and how the auditor is able to carry out his audit in relation to that. And we have mentioned that planning is critical, planning is fundamental to the audit that we are undertaking and as an auditor, we need to look at it in relation to that. Okay, so patient said, please go over purpose, the purpose again. So we say that the purpose of the audit simply, the auditor must determine why the audit work is being carried out. Now, to the audit firm, basically two things is for business common sense. We are there to make some money, all right? But not only that, you must make sure that whatever thing you are doing, you are not substituting money for ethical issues. So you must make sure that all ethical issues are appropriately dealt with in relation to that. So that is the idea about the purpose. Yes, we want to make some money, but we don't make the money at the expense of our ethical issues, at the expense of not being professional, at the expense of taking bribe and all of these in relation to that. So that is the idea about purpose. Patience, are you okay? Jane said, we need this video. Yeah, Jane, you can have access to it on the channel. It's available on the public. It's a public video, so it's still available on the channel. We're not going to shred it off. So it's available on the channel that you can get. Okay, Jane. Any other questions for me? Okay. So thank you very much for joining the stream today. It's always a pleasure to come your way. So we've got Patience, we've got Sarah, Cledos, Kwabena, Jonas, K. Sam, Osei Frimpong, Charles, Kelvin, Pawili, Jane, Foster, all of you guys. Thank you very much for taking the time. And I'll see you same time tomorrow as we continue with the part 2 of this particular lecture in relation to that. Okay, you are welcome, Jane, and then Patience. Okay. So if anything, like if any of you have any inquiry or whatever it is that you want to reach out, you can reach us on this contact that is 050-114-9296. You can WhatsApp or call this number in relation to that. If you have any inquiry to make or whatever it is, you can reach us on this line. If you are outside Ghana, you add +233 and you should be able to get to us in relation to that. So that is it. Thank you for watching. Many thanks for your time. You are welcome, Patience. So that is it. And I'll see you same time tomorrow as we continue with this session. Now, remember to also share the video with your friends and your colleagues so we get more people coming in to watch the stream We have a lot of content already also available on the channel on various subjects. So you make sure you take advantage of that and prepare for your exams well. My objective is to be able to provide you with some content, with some assistance, so that you'll be able to study well in relation to that. Sarah Wadia said, thank you very much, sir. God bless you. Amen, Sarah. And God bless you too. So in case you've not subscribed to the channel, you can subscribe as well to the channel. That way, when I go live, maybe you forget, YouTube will be able to notify you so you can join the stream and be part of it every day as we study in relation to that. So good night. Take care of yourself and stay safe.